Welcome to the Daily Digital Download for Monday, June 8th. Guys, we're well in to the last month of the first half of the year. I hope everyone is doing well. You were able to survive the tumult of last week. Let me just delete this erroneous. Hey, look, we are full on into the bear market. Last week was rough. Last week was a series of liquidations, price going down. Just not a lot of good stuff happening in the market. And it's hard to be in crypto when a lot of negativity is being thrown around, because you already have to have a little bit of a backbone to be in this space, and you already have to be a bit of a visionary to be looking at a technology that could bring all these changes tomorrow and hoping that they do happen. And then when you're looking at the backdrop of what is indeed happening in 2026, the adopters of today, of this technology of tomorrow, who's adopting it today, it's banks, it's TradFi, it's the least sexy among us. It doesn't feel like retail is being taken care of in the way that we were originally sold the vision of what blockchain and crypto would do for us. That being said, this is a bear market. And during bear markets, you have less apps being built or launched. You have less consumer-facing dApps. And largely, the dApps of tomorrow, the ones that are going to be used during the next bull run, are being built right now, silently and quietly. So look to the builders. I want to talk this week today, about a little bit about the market structure bill, building for AI agents, the latest in the ongoing feud between Sun Enterprises and Trump Enterprises, and then we'll finish the day on some likely buys from some likely characters. So, Coinbase, Ripple, and 200 other organizations wrote a nicely worded letter to Congress urging them to act on the Clarity Act, which is the market structure bill here in the US for crypto. Signatories included Coinbase, Ripple, Kraken, Andreessen Horowitz, Circle, and Binance US. And the letter said that a bill would establish a comprehensive framework for digital asset markets, clarify regulatory responsibilities, create workable registration pathways, maintain protections for software developers, and bring more digital asset activity into responsible US markets. Senator Cynthia Lummis said in a post yesterday that the floor is next because the Senate Banking Committee has passed Clarity Act. And so now the floor vote is next. And she said, we did not come this far to quit at the 5-yard line. For non-Americans, the 5-yard line is an American football reference. You have 100 yards on the field, and each team is trying to drive the football to the other end of the field. And once they cross the touchdown line, then they get points. And so the 5-yard line means you're 95% of the way to getting points. You're 95% of the way to a touchdown. Sorry if anybody does know American football and I just explained something super simple to you. But that's where we're at right now. We're at the letter sending phase. Last week, we also mentioned a letter or two that was sent to Senate to urge them to move on the Clarity Act. And so the block released a really just fantastic article. In fact, I am just going to go copy and paste this right now and add it. Read this for more information on Clarity Act. And this is just a comprehensive overview of what the Clarity Act is, who it impacts, how it impacts them, and why. And so I don't want to spend the majority of the space of this live stream going over it, but there are some areas I wanted to highlight. So as we mentioned in the previous article, crypto market structure refers to the framework of participants, platforms, rules, and infrastructure that comprise the digital asset markets. These include crypto exchanges, brokers, custodians, market makers, token issuers, investors, and the regulators that want to oversee them. Market structure is important because it determines who is protected, how prices are set, and whether large institutions can participate. Who are the main participants in crypto markets? Well, when you zoom out and you look at them, it's really a handful of groups. There's retail investors, institutional investors, crypto exchanges, market makers, custodians, token issuers, regulators. So, how do all of these groups come together? How do we create laws and rules for them to follow? Well, market structure will be looking at crypto exchanges, and exchanges sit at the center of the crypto market structure because the overwhelming majority of volume occurs through decentralized entities. Think Coinbase, think Binance, think along those lines. And both centralized exchanges and decentralized exchanges matter for market structure debates because custodial exchanges are the focus of most regulatory rules because they hold customer assets. But decentralized exchanges raise harder questions about who, if anyone, is the regulated party when a protocol runs autonomously as code on a blockchain. We see right now with Roman Storm, who is going through the American justice system for his ties to Tornado Cash. The argument for Tornado Cash shouldn't be, the argument shouldn't be those who created Tornado Cash are responsible for bad actors that use the mixing service. The argument should be that the Tornado Cash developers used code to create Tornado Cash. And for a long time, a couple decades here in the US, largely as a result of the cryptography wars of the 90s, it was found that code is speech. And here in the US, free speech is protected. And so now we have what's going on with Roman Storm as kind of like version 2 of that battle. And that's why this matters with DEXs, because are the people who code a DEX, are the people who code blockchain projects responsible for the way that people trade on them? That's one of the questions that the market structure bill is going through right now. And so what else matters? How does crypto and on-chain finance differ from traditional financial markets? And there's a huge list right here. There's 24/7 trading in crypto, Monday 9 to 5, 9:30 a.m. to 4 p.m. Eastern time, Monday to Friday, trading hours in traditional finance, amongst a whole plethora of other differences between TradFi and crypto markets. But most importantly, the differences are crypto offers faster settlement, global access, around-the-clock trading, and lower barriers for users. That being said, that with these new variants in access to markets, there's also variations in investor protection. So the market structure bill has several points of contention for several reoccurring challenges. And those include asset classification, cross-border activity, exchange oversight, and decentralized intermediaries, on top of other external political arguments that surround the market structure bill and the politics around it. For instance, the president having access and ties to World Liberty Finance and other crypto oriented businesses, because The president is a Republican. The Democrats don't want the current and hopefully the current sitting president, and hopefully one would hope just in general, the powers that be that have access to information that you and I don't, they shouldn't be allowed to make money off of crypto businesses while they're in office. And so this is another external market structure argument that is political when it comes to the market structure bill. So why do institutions care about market structure? Because for institutional investors, market structure dictates whether they can participate at all. And often at the core of this constraint is custody. Many institutional mandates explicitly require that there are qualified custodians to hold the assets on behalf of the institution and the institution's customers. An institution cannot buy a token unless there's a custodian willing to support it. And with a market structure bill, you create more clarity for who can be a custodian and how they can custody assets and which assets they can custody. When you have laws dictating all this, then you have institutions who are not operating in the gray zone anymore. There is a black and white rule book. There are rules and regulations they can operate in, and then they will go out and build products and services and features to oblige to those laws. Once those products and features are built out, then they can offer them to their customers. And what happens when TradFi and bank entities are using more blockchain, more crypto? Our adoption rates skyrocket and our technology is cemented. This is the inevitable goal that I think every blockchain advocate should be having in their mind as the end goal. It won't be the sexy vision for the person who bought Bitcoin in 2012 or 2015 or even in 2017 or 2021. There's going to be a massaging of what we, the crypto natives, the decentralized maximalists, the power users of blockchain, the adoption is going to look a little different than we had envisioned. But at the end of the day, that's okay. We just want our technology to be adopted because ultimately this technology is going to improve the livelihood of so many people around the world. So, if enacted in its current form or close to its current form, this is what the Clarity Act would provide today if Trump signed the bill as it is currently worded. Formally define a digital commodity into U.S. law, place spot trading of digital commodities under CFTC oversight, create a federal registration framework for digital commodity exchanges, brokers, and dealers, set custody, disclosure, and capital standards for those registrants, and establish a process for transitioning existing tokens between SEC and CFTC oversight based on objective criteria. As of right now, the bill is not enacted. Future amendments may change specific provisions. And the key takeaway, after this great article, which I highly suggest everybody go read, is that the Clarity Act would provide the first comprehensive federal framework for spot crypto markets in the U.S. End story. So what's the future of crypto market structure? Well, there are a few trends that are still playing out that will define the next phase of crypto market structure, regardless of how any single piece of legislation turns out. Long story short, U.S. regulation is shifting from enforcement by case to actual legislation that will create guidelines for how projects and products can launch in the U.S. and not wait for a Wells notice from the SEC. Money market funds, treasuries, and equities are increasingly being issued or mirrored on blockchains as RWA tokens, forcing traditional rules into crypto-native infrastructure. Stablecoins are now a regulated category of their own under the U.S. Genius Act, And institutional adoption continues to grow through ETFs, prime brokerage services, and integrations between banks and crypto custodians. All this to say that regardless of if a Clarity Act is passed or not, these 4 bullet points right here are enshrining blockchain and crypto into everyday use. With policy, we can have a fully rounded operational tactic here in the US for tokenized issuers, tokenized companies, and crypto in general. So head over to this article, What is Crypto Market Structure? A Guide to How Crypto Markets Work. A really just fantastic article written by the Block Research team. All right, moving on. What's going on in AI? Well, MetaMask has debuted its agent wallet, a non-custodial wallet, of course, designed for AI agents. It will enable autonomous trading across the Ethereum ecosystem, including swaps, perps, prediction markets, and liquidity provisioning on a suite of EVM chains and Hyperliquid. MetaMask currently has a quarter of the wallet market share. If you go onto crypto Twitter and you ask how many people use MetaMask, everyone is going to dunk and say that it's an OG wallet. It's old. Nobody uses it. But the funny part is that a quarter of all crypto participants use it. Agent Wallet was built with security in mind, giving the inherent trade-off between giving the agent freedom to act and keeping users' funds safe. Every transaction will undergo a mandatory simulation and abide by preset rules, which include daily spending limits and allow lists that are determined by each user. Joseph Lubin said, agents will manage real capital and make real financial decisions, and the infrastructure underneath has to be worthy of that. MetaMask Agent Wallet is the first agent wallet built with comprehensive full-stack security for that world, one where agents act with autonomy, security is mandatory, and the person behind the agent stays in control. End quote. The framework for Agent Wallet is framework agnostic, and it will be compatible with OpenClaw, OpenAI Codex, Claude Code, Hermes Agent, Cursor, and other AI providers. Super cool. Good luck with all of your agents. I hope they do well with your new MetaMask AI Agent Wallet. Moving on to, well, what do we want to talk about next? Here, let's talk about the feud between Justin Sun and the Trump family. HTX is the custodial exchange that was acquired by the Justin Sun umbrella a few years ago. And they're going to be delisting the USD1 stablecoin, converting it to USDT at a 1-to-1 ratio, of course. The USD1 stablecoin is the World Liberty Finance Platform stablecoin. It has, the last time I checked, around $5 to $6 billion in total market cap, which doesn't make it the most adopted stablecoin, but that also means that it has some users. Sun and World Liberty Finance have been getting into some scuffles over the past half a year. And this is just the largest or the latest in a series of back and forth blows that the two are sharing between one another. So HTX has already suspended trading for WLFI, USDT, USD1, USDT, BTC, USD1, and ETH USD1 pairs as of June 5th. HTX went on to say in a written statement, quote, HTX believes that the WLFI project team's unilateral freezing of these addresses, conducted without sufficient prior communication, adequate contractual or legal grounds, transparent disclosure, or adherence to due process, directly infringes upon legitimate rights and interests of HTX users and their assets, end quote. Long story short, actually, no, this is it. This is perfect. This paragraph is the context paragraph for what the battle is between Justin Sun and the Trumps. The dispute marks at least the second high-profile use of WLFI's on-chain freeze function. The Trump-linked backed project blacklisted Tron founder Justin Sun's wallet in September of 2025 after he moved roughly $9 million worth of WLFI tokens between addresses, including HTX, where he serves on the exchange's global advisory board. Sun has since sued the project, alleging the WLFI contract includes a hidden backdoor that lets the team freeze investor tokens without notice or consent. And now the two are duking it out in American courts. So, this is just Justin Sun wielding his influence. HTX is quite a large exchange. There's a lot of volume that's done on that exchange. And now he's freezing out the WLFI and USD1 markets. Moving on. Let's zoom out and wrap up with some positive news. Let's spin the boring bear market that we're in, the painful bear market. Last week was painful, just red across the board for all of crypto. Bernstein says that Bitcoin's boring cycle doesn't undermine its store of value thesis, despite $2.6 billion of ETF outflows this year. The research and brokerage firm Bernstein pointed to Bitcoin net inflows from ETFs and treasury companies totaling around $12 billion so far in 2026, compared with roughly $60 billion in 2025. So there's still inflows, just not at the same rate as was happening in 2025. ETFs accounted for $2.6 billion in net outflows over the same time period, implying that the inflows have been driven by treasury companies. And when we look at the treasury companies, I had another article that I didn't include in today's daily digital download that outlines like 20 of the Bitcoin treasury companies. Regardless, the market is dominated by retail's obsession with AI. $2.6 billion in outflows year to date are almost encouraging, analysts say. Almost encouraging. One of the theories for why crypto is tanking right now, why equities tanked last week in commodities, is because the big three frontier foundations in AI are all but alluding to forthcoming IPOs this year. I believe Grok, Anthropic, and OpenAI are intending to do IPOs, an initial public offering, which is basically going to the stock market. And so the theory is that a lot of capital across markets, not just risk-on markets like crypto, but across equities and commodities, a lot of investors across all these markets are preparing for the IPOs and are becoming liquid. And to do so, they're selling all their other assets. This is one of the theories for why we saw just the multi-market sector sell-off at the end of last week. According to Bernstein, the institutional base for Bitcoin has expanded across wealth management platforms, broker-dealers, private banks, pension funds, and sovereign wealth funds. Additionally, 61% of the circulating Bitcoin supply has remained inactive for more than a year. Hello, hodlers. And this is just going on to what I was just saying. Retail investors have crowded into AI this cycle, leaving Bitcoin with a healthier market structure of diversified ownership across treasuries, corporate treasuries, wealth platforms, pension funds, and sovereign funds. While Bitcoin flows have moderated, capital has migrated towards digital asset infrastructure linked to RWA tokenization, with platforms like Hyperliquid seeing elevated volume growth in tokenized equities and commodities markets. Long way of saying blockchain is being adopted, tokenization is being integrated into mainstream processes. There's a reason for capital moving outside of blockchain, and that being said, Bitcoin is being more and more diversified into larger and more stable hands. Cool. So let us end this week, or the beginning of this week's DDDs, the first of 5 this week, with some positive news. Michael Saylor sold 32 Bitcoin last Monday, freaked the market out, buys 1,550 this week. Wow. Strategy purchased another 1550 of Bitcoin for approximately $101.3 million at an average price of $65,332 per Bitcoin. To put this into perspective, Strategy's holdings are equivalent of more than 4% of Bitcoin's total market supply. 4% of Bitcoin's 21 million supply cap. Wow. Even though Strategy is sitting on $10.5 billion of losses at current prices. Additionally, Strategy added to its USD reserve, which now sits on $1 billion, which is up from $900 million disclosed on May 31. This is a big deal because the whole skerfuffle, the whole problems that we were seeing last week associated with Strategies, the reason why it was assumed they sold the 32 Bitcoin was to test market liquidity so that they could have funds to pay back the STRC stockholders. The STRC stock guarantees 11.5% yield year over year, which is around $1.5 billion in liabilities that Strategy has to pay every year to STRC issuers or issued holders. And so one of the things that makes the market feel better is seeing Strategy with a larger USD reserve. And that's exactly what happened. They just padded their USD reserve with another $100 million, raising it to $1 billion, almost covering a year of dividend returns alone. So now the best thing that can happen to Strategy is the price of Bitcoin goes up. But they bought more. They sold 32 on Monday, and then they bought 1,550 over the weekend. Fantastic. And additionally, lastly, Bitmine added 127,000 ETH, bringing its treasury to 5.54 million ETH. As Tom Lee calls this sell-off, superficial. The official Bitmine treasury is now at 5,543,872 ETH, or 4.59% of the total circulating supply, placing Bitmine at 92% of the way to its 5% ownership accumulation target of total ETH, which would be at around roughly another 490,000 ETH needed. Tom Lee attributed the stepped up pace to Ethereum's price weakness. He went on to say, "We increased our buying as we believe this pullback in ETH prices does not reflect the strengthening of Ethereum fundamentals." Hey, look, Saylor and Lee are bulls and they believe in their vision. Anyone on CT could have taken easy shots at them last week, and there were tons of people. There still are. Go look at all the accounts, grave dancing on Saylor and on Lee, talking about the $10+ billion that each company is down right now on paper from their holdings. But I also want you to remember this. And for anybody who's been in blockchain and crypto for a while, remember these moments because crypto's in a bear market. A lot of other markets are doing good. And this is the time when everybody is laughing at you, is making you feel like shit for allocating into crypto resources because crypto down, everything else up. But remember 2017. Remember 2021. Remember 2024. Remember when crypto is doing so well and everybody feels like they're late to the party and they all pile into crypto. These are the moments when you're going to be looking back and thanking yourself for having faith in an asset class that you thought would go up because it did happen in 2017, 2021, and 2024. And so, if you believe in the long-term perspectives of blockchain and crypto, then moments like this, years like 2026, are times to be allocating in. And so right now, while everyone is grave dancing on the people who are hurting the most, screenshot those accounts. Go back and look at them. when crypto is up, when crypto's mooning, when crypto's in a bull market. And just remember that they will be wrong in that moment. And even though they're right now, a broken clock is right twice a day. So friends, fear not. If you have conviction, coinviction, then stay on the path you're on. Don't let the naysayers shake you out. If you think that the price of crypto has nowhere to go but up, then don't lose your conviction, because this is the what's the best way to put this? The fundamentals are the strongest in this bear market out of any of the bear markets I've ever been through. And so we can't be shaken out. We can't be stopped. We can't be stomped out. All right, folks. With all that said, thank you for tuning in to the Smart Economist, the Daily Digital Download. Geez, sorry. I have too many of these shows. If you haven't yet, please subscribe to our newsletter at thesmarteconomist.beehive.com. We will be back tomorrow to bring you all of the news and information that you need for what happened in the broader blockchain and cryptocurrency markets and vertical and asset class over the past 24 hours. Thank you so much for tuning in.